Now, just 3 years ago, the National Australia Bank was Australia's smallest of our big four banks by market value, and it was seriously undervalued by investors. This week, though, NAB is the second biggest bank and is gaining market share in both home mortgages and in business lending. Its half-year profit was ahead 4.1% to $3.5 billion. Its dividend higher at 73 cents a share. But even though rising interest rates improve bank margins, NAB's chief executive, Ross McEwan, remains wary about the future. I spoke with him a little earlier.
Well, look, it certainly is a different condition, Ross, and what we've seen is an economy that has been booming away. We've seen inflation getting up to around over 5%. And that's not the position that the Reserve Bank or anybody would want to see. So we've got to start cooling it down. We're also seeing in the business market probably credit growth for businesses around 8%, which has been the highest since the global financial crisis some time ago. So conditions are very strong, and the question is they appear to be too strong and need slowing down for the longer term.
OK, so as we move through this cycle of higher interest rates, a bank such as yours, what do you do in terms of access to credit for homeowners and also for business? Do you start to ease that back a little bit, or do you continue to roll out that credit to keep funding the growth, as it were?
Well, we've certainly been funding the growth in the last 6 months. I think we put on $31 billion of assets onto the book, which is probably the biggest we've ever done, and pretty close to exactly the same in deposits to fund it, Ross. So it's been a good equal balancing. But I don't expect that to continue on, for every 6 months. So we have seen a very, very strong period across every part of our business. Interest rates going up, I think, will slow down the housing market. It'll probably make it, people will start looking around and refinancing will happen more and more in the marketplace, and we need to be making sure we've got a good proposition for every household. But I do see business growth continuing quite strongly into the next 12 to 24 months, and I think that will be great for Australia.
And the other point also, we're seeing here a graphic of your forecast for the cash rates going up to that 2.5% mark by about May 2024. But one other aspect of this is as those interest rates rise, your net interest margin also rises. So there's a bit of a trade-off here. Though you're making more money technically as a bank, there's also the prospect of increasing bad and doubtful debts that you'll have to allow for as well.
Look, there certainly is. And look, what we've seen for 11 years, interest rates come down and our margin on our book, which is the difference between what we borrow money off customers at and lend them to, has shrunk. And as interest rates go up, that tends to widen again. I do think, though, that there will be a lot of competition in this marketplace that will make it quite difficult to expand net interest margin to the extent that people think. You've got 160 different players in the mortgage market, which is great competition, good for customers. So I think there'll be some of that will be competed away. But you are quite right. In a rising interest rate margin, banks tend to do a little bit better than when it's going the other way. And I expect to see that, the interest rate margins expanding a wee bit over the next year or two.
So it's interesting because you even note about the housing market there, because even though you put on market share, significant amounts of market share, it came at a cost because clearly those new customers were coming in at much cheaper rates, or indeed people refinancing were also taking advantage of the cheap rates at that time. So, to a certain extent, that's the reason why you end up making more as the rates rise, because some of those customers end up paying more. And that's even the difference between the fixed rate loans and the variable rate loans, the proportion of those that you're issuing right now.
Yeah, and you're quite right, Ross, to pick up the point around fixed rate loans and variable loans. A lot of customers have gone to fixed rate loans because they've been much cheaper than variable, and it gives them absolute certainty in the household how much they pay every fortnight or every month. But fixed rate loans have become more expensive because our cost of funding from wholesale markets has gone up. And now people are starting to move towards more variable loans as they roll off their fixed. And that's expected because they tend to see the variable loan over time cheaper for them. And we actually do get a slightly better margin out of a variable loan than a fixed rate loan. So you're seeing a number of things happening in the marketplace. What will be very interesting to see is the competition, what happens with competitive pressures in this marketplace. I think they'll be strong over the next couple of years, particularly as customers look to refinance if their bank's not giving them a good deal.
Okay, so let's go to the business side, because clearly that might be one area that might have pressure. Now that things are starting to normalise, rates starting to rise, but cost pressures starting to increase. And even the bank today has acknowledged that there are growing cost pressures in terms of your own costs of staff, costs of suppliers. But I want to go to business. If business is coming to you right now seeking loans, are you going to be more critical in the way in which you approve and assess those loans? Is the credit going to be relatively straightforward for businesses to achieve into the future?
Look, at the moment it's pretty straightforward because businesses are in pretty good shape. And I put that back to, whilst we've had COVID in the last 2 years, we've had a federal and state governments really looking after businesses. Some of the businesses have done well through COVID and others have gone into what semi-hibernation as they've had to close down, particularly the central city businesses. Well, they're starting to open up again now. And you can feel that vibrancy in a city like Sydney or Melbourne, and it'll be the same in Brisbane and in Adelaide. You're starting to see people back into the city. Therefore, you're seeing cafes, bars, restaurants, sporting events are getting people back into town again. The theatres are open, so you're starting to see businesses getting going again. Now, those were good businesses, they're now good businesses again, and we're happy to lend to a good business. But you're seeing the credit growth there starting to really take off, 6 to 8% growth. We haven't seen those sort of growth rates for quite some time in the market. And we're open for business. This is the sweet spot for a NAB. We're the largest business bank, and it's we've got the bankers looking after customers, and we're seeing this as a good market for us at the moment. But it's only in support of customers and what they want to do.
Okay, so then take me to the cost pressures for the businesses that you service and even for your own business. If the borders, which are now well and truly open, but if there is a significant influx of students, of new skilled workers, does that really take some of those cost pressures away from a bank like yours? Or really are the cost pressures otherwise external as well?
Look, all of the pressures that a household has affect a business as well. That we're seeing the cost of third parties or businesses we use pushing through cost increases into us. We're seeing our labour cost of our colleagues going up because there's real demand for technology people, digital engineers, bankers right across the board. So we're seeing the pressures on our business as well. And yes, we get some productivity out of the technology we employ, but we're like every other business, we're seeing cost pressures on us. And in some cases we can pass it through, in many cases we can't, we have to absorb. So we're no different to any other business.
Jerome Powell, the chair of the US Federal Reserve, was pretty candid when he said, unless this period of, sort of the tightening that's taken place, the rising of interest rates, is handled well, there could be a recession at the end if it's handled poorly. Is that one of your fears, that really right now this is a pretty delicate balancing that government and also our central bank, the Reserve Bank, has got to get right so it doesn't really, if you like, hurt the economy, if you like, overcook these interest rate rises?
Look, absolutely right. And it is that fine balance between lifting rates to take some money out of the system, because that's effectively what happens when you're actually raising interest rates. You're taking money out of the economy to pay your mortgage or your business loan, and it takes it out of other things to slow the economy down. And it is a fine balance of when you try to slow an economy down, do you tip it over? And that's the fine line. And that's something that the Reserve Bank's got to be very careful of over the next 24 months and be finally looking at, how much interest rates are appropriate to slow it down without completely stopping it. Because that's something we don't want in the Australian economy. It's very strong, but at the same time, we do not want to tip this over. And it's a fine balance.
Ross McEwan, Chief Executive of the National Australia Bank. Always good to chat to you, and many thanks for your time today.
Thank you, Ross. All the very best.